Welcome. Thanks for joining us on Market Call. I'm Marella Fernandez. Gordon Reid with us on the show today, President and CEO of Goodreid Investment Counsel. He'll take your questions on U.S. equities. Here's how to reach us. Call us toll free 1-855-326-6266. You can also email your questions, marketcall@bnnbloomberg.ca. Gordon, good to see you. Thanks for coming in.
Thanks, Marella. Nice to be here.
We have the price of oil sustaining above the $70 mark. Do you think that longer term it could sustain this, even with Iran and Israel possibly wrapping up?
Of course, it's hard to say. The price of oil is notoriously difficult to peg. What we do know is that it is a risk asset that will respond to geopolitical tensions, and we've seen exactly that. What it does afterwards, after things settle down, again, hard to know. The tendency, I think the consensus has been relatively negative, that it'll stay down. My feeling is that probably that won't happen, that we will reach a point of equilibrium where it will be a non-topic. I find a lot of times when one side of the conversation becomes heavier than the other, you tend to correct. It's almost self-correcting. So I wouldn't be surprised to see oil a little higher as we move through the end of the year.
You mentioned that you think that investors are still cautious. What indications are you seeing?
Well, we're certainly seeing money flow and the amount of money that is sitting in interest-bearing accounts at very, very high levels. So even though the markets are challenging all-time highs, investor sentiment is still quite cautious. I think the period of April is still close to people's in their memories and will be for a while. I don't think that's a bad thing. I think a little bit of caution is a good thing for the market. My experience over the many years that I've been doing this is that the time to worry is when people are super optimistic and things get carried away and they take prices to unsustainable levels, and that invariably ends quite badly. So this doesn't cause me any pause. I like this, and I'd like to see this money sort of bleed into the market as optimism improves.
We are moving closer to the U.S. midterm elections. What change do you expect to see in the markets as we do that?
Well, I think that some of the effects that President Trump has had on the markets, that is his unpredictability, sort of the chaotic nature of his style, will start to dissipate because he and the Republicans are going to be incented to maintain their balance of power in the House and the Senate, and that's going to be investor friendly. He's going to, I think, have to be more predictable and less contentious. The market will like that, I think. So we've gone through a very rough patch with the policymakers in Washington, and I'm hopeful that we'll see policy and government less involved in the direction of the markets, and we'll get back to good old-fashioned corporate results yield good stock prices, or good corporate results yield good stock prices.
Got it. All right, we're going to take a quick break. Gordon Reid of Goodreid Investment Counsel is with us today, taking your questions on U.S. equities. Here's how to reach us. We're back in a moment. Welcome back. Thanks for joining us on Market Call. We have Gordon with us today, and we have an email for him from Ashley. She says, please give me your opinion on Pinterest, pins on the New York Stock Exchange. Very well-used site. People go on there to sort of look at different design ideas, right, for example. What do you think of it?
I'll start off with the worry, and that is I'm worried that from a technology standpoint, the moat is not wide enough. The technological differences to be able to deliver this type of a product to the consumers is not wide enough. On the positive side, they have about 500 million monthly active users, which is pretty impressive. Their revenue growth is good. They've had some problems with initiatives on marketing, and some have been less fulfilling than others. Trades at a very reasonable multiple, Morella. So that gives you some confidence that it's not going to be a complete dud. So I think from my standpoint, there's not quite enough there to get me interested enough to devote our clients' capital to it. But it's a company to watch and see how they develop, and you never know in the future.
Got it. Okay, let's go to the phone lines. On the line today, we have Jim from Elliott Lake with a question. Hi, Jim.
Good afternoon. Gordon, I'd just like to get your thoughts on John Deere, a company that we're all very familiar with.
Yeah.
Your thoughts on it kind of yesterday, today, tomorrow. More importantly, is this still a good entry point? It's had a very nice run here over the short and long term.
It has, and John Deere is a difficult cyclical because it's very heavily reliant on farm incomes and also on commodity prices, and which of course are related, and those are hard to predict. And of course, John Deere, you don't buy them cheaply. They're a major commitment, and farmers have got to have a lot of confidence to go out and buy a big piece of equipment.
Sure.
So it's been a difficult stock to predict. We have owned it in the past and done okay with it, but there's just other areas of the market, even other cyclical areas, that I think have a little higher predictability that I would gravitate to over John Deere, respecting, of course, the fact that the stock has surged to all-time highs.
Got it. Okay. Well, hope that helps Jim out. We're going to go to Anne from Scarborough with a question. Hi, Anne.
Oh, hello. Gordon, I own shares in NVIDIA. Oh, boy. And would you recommend I buy more or just wait for a downturn if there will be such a thing? Thank you.
Yeah, well, congratulations. It's been obviously a very successful stock over the last couple of years. To my last comments about Deere, completely different industry, but certainly semiconductors are also a cyclical industry and have their highs and lows. And this one, is quite possibly in the very early innings of a cycle that will take AI to perhaps areas that none of us can imagine, and that's exciting. It's actually getting cheaper as the price goes up, and that might sound counterintuitive, but of course price and earnings are related, and the market will reward companies that do well in terms of fundamentals. So as earnings go up, price goes up, and NVIDIA's price has not risen in the last few months to a year at as fast a rate as their earnings have risen. So the stock has actually gotten less expensive to the point where it becomes a little bit interesting. In terms of Anne's question about whether she should add more, I'm going to have to pass on that because I don't know Anne's circumstances as to how her portfolio is constructed, what percentage she has in NVIDIA, what percentage she has in growth stocks versus value stocks, and so on. So those are the types of exercises that we go through at Goodreid, pretty rigorously when a prospective client comes to us. So I would pass on that and encourage Anne to, if she uses a investment professional, to ask her investment professional from a portfolio construction standpoint what he or she thinks about adding more NVIDIA.
What kind of mix do you generally recommend? She's got NVIDIA for tech, but what's the mix overall that you recommend?
Mm-hmm. Well, you have to make sure that you have sector and industry diversification, and there are 11 GIPS or industry sector groups. I would say you want to have 7 or 8 of those groups in your portfolio. Within each group, you have a multiple number of industries, and I'd say you want to diversify amongst those. And then finally, down to the individual company, you want to make sure that you have enough companies in your portfolio. And I would say we normally have about 20 to 25 companies in a standard portfolio, and that's traditionally a good mix between risk and reward. But you also want to make sure that each of those companies is not overweighted to an undue degree. So we tend to make sure that they're in relative balance. So if you have 20 companies in a portfolio, by my math, each would represent about 5%.
Yep.
You probably wouldn't want to go past 8% on the high side, and when it goes to the low side, if you still like it fundamentally, look to add to it.
Got it. Okay. We are going to take a quick break. Gordon Reid sticking around to take your questions on American stocks, U.S. equities. We're back in a moment. Welcome back. Thanks for joining us. Let's go to the phone lines. Joseph is on the line today. He's calling from Montreal. Hi, Joseph.
Good day. Thanks for taking my call. Just started parlaying off that last question about portfolio construction. I want to learn from you what defensive strategy you employ to smooth out some of the rockiness we've seen in the markets lately. Mm-hmm. Do you prefer utilities or do you prefer consumer staples? And so I just want to learn from you your defensive strategies and how you feel they fared in the spring during that rockiness. Thanks in advance.
Yeah, quite a few questions in the past few months on exactly that.
Yeah, it's a broad topic, and let me see if I can distill it. When you think of defensive, you think of predictability. You think of knowing or having a company that will react in a narrow band of outcomes, and that takes you. Joseph mentioned utilities or consumer staples, that type of things. But you also have to make sure that you don't have the predictability of a loss. That's also predictable and might come under the umbrella of defensive. So you want growth. You just are willing to give up some of the upside of the reward for some of the peace of mind.
Yeah, something steadier.
Sure,
yeah.
Sure. So that often takes you to companies that have very little variability in their own business model. So they have a sustainable pathway to a predictable result. That allows them to pay out a higher percentage of their retained earnings in the form of dividends or use capital for buybacks and that type of thing. Also quite defensive. Mm-hmm. So I would point towards things like consumer companies, things like telcos. Utilities tend to be super defensive because they really just provide a yield. And you know, that brings up one of the issues of where to place your defensive money. Do you want to create a higher dividend, higher income stream out of the US or out of Canada? And we're seeing right now some incoming calls from people talking about the new tax bill in the United States, and more specifically Section 899 of the tax bill, which is entitled an enforcement, I'm going to read this, enforcement of remedies against unfair foreign taxes. So yeah. It's, again, out of the...
It basically means Canadians are going to pay more if you have investments in the U.S.
They could. Yeah. And there's a list of countries that have been deemed to have been practicing discriminatory tax practices. And this points to the 2024 digital services tax that Canada implemented, where it charged 3% of revenues off basically the communication services companies for doing business in Canada. So there's a possibility of this, and the end result is that it's going to lead to a small incremental increase in the withholding tax that the U.S. would charge. If you have a dividend or interest in the United States and have filled out a W-8 Ben form, which conforms with the U.S.-Canada tax treaty, you'd pay 15% tax, withholding tax. This bill would consider adding 5% per year for 7 years. We've looked at this in some depth, and we think it's a bit of a red herring. We've actually written an article on it that's on our website at goodreid.com. You can go to the site and look at articles, the articles section, articles and insights. Just sign up and you'll see that article and a variety of other articles that we've written. And we look at how it affects stock owners and whether it should make a difference in your ownership of U.S. securities. So feel free to go and look at that in more depth than I can get into now.
Got it. Okay, let's go back to the phone calls. Joe is on the line from Montreal. Hi, Joe.
Hi. I guess it is from what Gordon just said. It's kind of on my question. I've owned Bank of America for decades. I'm retired. It's in my cash account, and I'm thinking about what his forecast is for Bank of America, and if I should maybe start taking some profits, incrementally over the next couple of years to leave less of a tax bill for my kids, and also maybe just because of the exchange rate, what it is right now, it would be prudent for me to do exactly that right now, start paring down my holding there. I'd appreciate his insight. Thank you.
Okay, Joe. So you were basically saying you think it's a red herring. So do you think you need to start tapping out of that market as a result of the big, beautiful bill?
No, in fact, the opposite. I think that it's a red herring in that people are saying, well, there's a new tax coming, so we should consider
investing in the
paring
US,
back our exposure to the U.S. I think it's the opposite, that it's really an immaterial amount of money. Now, you've got to get into the depth of things. There's a difference between owning a stock portfolio with, say, a 1.5% dividend yield and owning real property, owning a home or owning a REIT, which is income producing, income intensive, or owning other properties that have higher interest or dividend income. Those may lead to other actions, and we would strongly encourage people to get tax advice on that. We're just dealing with the capital markets, with the public equity markets, and our conclusion is that it's not really a big issue. As far as Bank of America goes, I would strongly encourage Joe to maintain a full weighting in the financial sector. We think that that's prime for doing well in the next leg of the market. The sector is inexpensive. It's got policy tailwinds. They are executing well. They're probably the best capitalized they've been in their histories. So we particularly like that area, and we do own Bank of America.
Got it. Okay, let's get to one more phone call. Capel from Whitby, Ontario has a question. Hi, Capel.
Hi, good afternoon, guys. I have a question for Gordon. I've recently added a position in United Health Network during the recent drop in the stock. I just want to take the opinion from Gordon that what are your thoughts on the company and the future forecast about this?
Yeah,
Sure.
big stock drop off there.
Yeah, absolutely. And time will tell as to whether it's deserved, whether they recover or not. There are certainly some fundamental cracks in that part of the market, the Medicare and Medicaid, the reimbursement programs. Their medical cost ratios have risen, and we'll see whether this is a blip or whether they maintain a higher level. Some of the reasons that they've risen seem to have some staying power. There was a bit of a COVID echo where people during COVID or shortly after got fewer procedures than they normally would, and now they're catching up, and that's increasing prices or increasing costs for the insurers. But some of the issues may be transitory. Some of the Medicaid and Medicare reimbursement rates are reactive in nature, and the way it works is that these insurance companies incur certain costs, and the following year, the rate is reactive to the experience. So it's a timing issue as opposed to an issue that's more permanent. But to Kapil's question about United Health in particular, we owned Elevance, the former Anthem, in our portfolios, and we think that there's more opportunity there. It also has been hurt by higher reimbursement rates and that type of thing. But a lot of Elevance's business is fee-based business where they don't take on the full liability of these higher rates. So there's going to be less pain. And in fact, they've been loud and clear about the fact that even though United Health is warning the street that results are going to be less than great, Elevance is saying, well, our results are going to be good, but the stock has fallen. We think that's the opportunity here. And I would strongly recommend people move away from United Health and towards Elevance.
Got it. Okay, we're going to take a quick break. We're going to have a look at Gordon's past picks in a moment. Welcome back. Time now to go through Gordon's last picks from June 11, 2024, so just about a year ago. At the time, he chose Amgen on the NASDAQ, which is a biotech company. They do medicines. They were $300.70 at the time. Dropped a little bit to $293.63, so a 2% return drop, 1.18% upside. Have they taken the hit, sort of all these healthcare-related companies have taken?
Yeah.
Yeah.
Being in healthcare in the last year, in fact, last 3 years, has been very difficult. It's been a somewhat bifurcated market, really rewarding growth, and in particular, technology growth, consumer services, the Amazons of the world, and Googles and Metas and so on. And lately we've seen a widening of the market towards some industrials, but healthcare really has been a non-starter. Yet there's some really good companies, and we think Amgen is one of them. They spent $28 billion a couple of years ago to buy a company called Horizon Therapeutics, which really deepened their bench. They're a long-standing biotech company, one of the original true biotech companies, with Epigen and anyway, a couple of blood cancer drugs and Neupogen. Okay. They're just a solid company. They trade at a fairly low multiple. They have a great dividend, well over 3%. As I said, they've spent some money on acquisitions which have deepened their bench of potential new drugs. And as a kicker, they've got Meritide, which is a GLP-1 potential competitor to, of course, the Lilly and the Novo offerings. And so far, through the phases, through 1, 2, and 3, they're doing fairly well with it.
Got it. Okay, let's get to your next pick from June of last year. First Solar, they do solar modules, $294.54 at the time. Now down to $141.85 US dollars, 52% drop, return and total return as well. Is this because there's a push in America away from solar, or is this something else involved in the
No, that's exactly what it is. And we bought it on the basis that it was a domestic supplier of panels. There was an oversupply in China, which had driven prices down. But our theory was that the domestic producer was going to be protected and given an advantage over foreign producers. Obviously didn't work out. And in fact, this morning in the Senate proposal to the Big Beautiful Bill, they're proposing that they end tax incentives earlier in 2028 as opposed to later years. And that has all of the solar companies dropping dramatically. Now, fortunately for our clients, we sold this company in February because we saw this coming.
Yeah.
And decided, well, just, as they say, your first loss sometimes is your best loss. And it's difficult, of course, for any investor to admit defeat it's hard in life to admit defeat, but that's what you have to do when you invest, because even the best investors are going to have, say, a 70%, 65% success rate, and that's the best. So you look at the other side, 30 to 35% of the not so good stocks have to be dealt with, and you have to have a very good discipline. And that's what we used in February with First Solar.
Okay, let's quickly go through CrowdStrike, which was your third pick from last year. 384.63 American at the time, up to 486.64, so 26% return, and total return 26% as well. Cybersecurity, is this one you will hold on to for some time?
I expect we will. It's the preeminent cybersecurity stock and company out there. They just recently got accreditation to become more involved in government operations, which of course is a huge market for them. It's a very expensive stock. It trades on future opportunity. We've used it as a source of funds. We sold some in May, but we also used it, you can see, back in July of 24. It fell pretty precipitously on a software update that didn't go very well, and we saw that as an opportunity. We never let it get past that 8% mark that I talked about earlier in the show, because there is some risk associated with this company and this stock, but it also offers fantastic opportunity to be involved in a space that we think we should be involved with.
Got it. We're going to take a quick break. We're going to get back to your phone calls and your emails in just a moment. Welcome back. Let's go to the phone lines. Ray is on hold from Kingston, Ontario, with his question for Gordon. Hi, Ray.
Hi there. Thank you for taking my call. Gordon, thank you for providing this service. You're a veteran advisor for decades, and I appreciate your opinions. I would like to ask you on Visa or MasterCard, which one do you prefer? They're both very similar business models, but there are differences between the two. Which one do you prefer and why? Thank you.
Great. Good question, Ray, and thank you very much for your comments. I appreciate that. We own Visa, and if you go back long enough, you'll probably be able to find that we own MasterCard way back decades ago. But we've owned Visa for at least a couple of decades. And it's done very, very well for us, for our clients. You asked for a compare and contrast. I guess, first of all, on valuation, Visa trades a few multiple points cheaper than MasterCard. Visa is much larger than MasterCard. In fact, Visa is larger than all its competitors combined, and American Express and PayPal and you name it. MasterCard is more internationally active. They have a higher international rate. Visa has a higher percentage of debit cards, which is a faster growing segment than credit cards. So when you put it all in the hopper, we like the fact that Visa competes extremely well on growth rates with MasterCard, yet trades at a lower multiple, so it's cheaper. And we like the fact that the debit card business is growing faster than the credit card, and that's being adopted more readily. So I would lean towards Visa. Feet to the fire, though, they're both great companies. They're both good, but you have to make choices. And we do a lot of peer group analysis at Goodreid. Whenever we find a good company, we always say, well, who are their competitors? Maybe we'll find a better one. And it has happened in the past, but in this case, Visa.
Got it. Okay, let's go back to the phone lines. John has a question. He's in London, Ontario. Hi, John.
Hi, Marilla. Hello, Gordon. The accolades continue. Thank you for CrowdStrike. I borrowed your thesis and managed to pick it up just off the bottom in August.
Great.
My question today is on Netflix. Is this the preeminent stock in the streaming business? And should I add to it here, or should I explore the infrastructure idea and the Trump bump and buy something like Sterling Infrastructure? Thanks very much, Gordon.
Netflix is a great company. It's not inexpensive, but they have staked out their rightful place as the leader in streaming. And I think anybody who owns one of the competitors, whether it's Disney or one of the cable companies, should be very careful because Netflix has the sort of the power here. You have to be a little bit wary of Netflix. It's a bit of a complex accounting exercise. Of course, when you do a film, all of your costs are sunk costs. You put the cash up front, yet from an accounting standpoint, you amortize that cost over time. So earnings don't really reflect the true cash impact on an expanding portfolio of new releases. So you have to be a little bit careful with that. And for the longest time, Netflix was challenged on a cash basis. They didn't produce free cash, even though they had moved into a profitable situation. That's passed. They now are producing free cash, which is good for owners. In terms of the second part, I'm not familiar with Sterling, but the infrastructure play in the United States is one that we're very involved with at Goodreid. We've got a number of companies that I've mentioned on the show before. One that's done extremely well for us that I'll mention now is DICOM. DY is the symbol, and it's been a big winner for us. They're basically rewiring North America for higher level fiber, 1 gigabit fiber, and have all of the major telecoms and streaming companies
as their clients. Got it.
Yeah.
Okay. Let's go back to the phone lines. Paul's on the line with his question. He's in Newmarket, Ontario. Hi, Paul.
Hi, I just wanted to know what your thoughts on Tesla were. I think it's down 15% year to date. Would it be a good time to add a position or possibly hang up now?
Okay, thank you. We just missed the last part of the question, but Tesla's been very volatile, of course, with Elon Musk at the head, but he has gone back to run the company.
He has, and you know, I'm on the record as saying that this is not a company that I would get involved with. It's too volatile, and the leadership group is far too volatile for my liking. You know, we're putting real money up here, and you know, to have it exposed to reactions of tantrums or you know, silliness, to be honest with you, even though, you know, nobody can argue how incredibly intelligent he is, that doesn't mean that all of the other aspects of his character are sound, and I would question some of them. So no, I wouldn't buy Tesla here. I've long argued that if it's a car company, it's a ridiculously priced car company. If it's a technology company, show me the success in the technology. He spun out a lot of that, you know, as SpaceX, for example, obviously incredibly successful. But on the basis of Tesla, I wouldn't be a buyer.
Would you go Amazon then?
Amazon we own,
Okay.
and we like Amazon very much. Of course, a completely different company and completely different leadership group.
Got it. Okay, we're going to take a quick break. Back with more phone calls and your emails in just a moment. Welcome back to Market Call. Thanks for joining us. Ghulam is on the line from Toronto with a question. Hi, Ghulam.
Hi there. Good afternoon to you. My question is on GE, General Electric, all the three companies in that umbrella. I'm just debating whether I need to hold and take some profit, or just hold on for further gains. Mm-hmm. I'd appreciate your opinion. Thank you.
Thank you for the question. What is General Electric up to these days?
Well, Larry Culp took this company that was on its deathbed and resurrected it and did a fantastic job. Now split up into three companies. There's the old traditional GE, you know, the maker of jet engines and you know, that type of thing, and then there's GE Verona, which is their technology or the turbine company, and then GE Healthcare. And those are the three pieces of GE. The first two, GE and Verona, for us, just have run so far that they're just too expensive. The multiples don't support future cash flow growth. GE Healthcare is an interesting company. They have an opportunity to benefit from AI, and a lot of medical technology, of course, is benefiting from AI. So that's a company that continues to be on our radar. We are not an owner of it at this point, but I continue to come back and look at it. A great success story. And whether Gallup should take profits or not, from a portfolio management standpoint, I can't really answer that because I don't know the makeup of the portfolio. I would say that if you've held it and it's run up from a percentage that you were comfortable with to a percentage that is at the upper end of your band, don't be shy to trim. We trim all the time. Nothing wrong with taking profits at highs and reemploying them.
Got it. Okay, let's go to another phone call. Renata's on the line from Oakville, Ontario. Hi, Renata.
Hi, good afternoon. My question to you is on Alphabet, please. About a month ago, it was trading at around 150, and now it's 177. Is that not a little bit expensive, or would it be a good idea to get into it now? Your opinion is much appreciated. Thank you so much.
Okay, so obviously Alphabet hasn't come back from where it was at the start of the year. Some of the tech companies have not.
Right.
What do you see for Alphabet, parent company of Google, growth-wise?
The knock on Alphabet now is that their search business, which they had cornered, they had 92% of search.
Is in jeopardy.
Is in jeopardy, yeah exactly. And what's going to morph out of that? So on the negative side, it's that everybody's going to eat their lunch and their search is gone, so this company is just going to be a shadow of its former self. On the positive side, you've got, well, they're going to lose some business in search to AI, but they've also got a very big AI presence. And is this not a bigger pie story where, you had 92% of a small pie and now you're going to have X% of a very, very large pie. And maybe in absolute terms, you have more than you had before. They also have other interesting properties. They have YouTube, which is the largest actually streaming business in the world, not movies like Netflix necessarily, but YouTube has over 2 billion active monthly active users. So it's a very, very large and profitable company or piece of a company. And they also have Waymo. And that of course offers tremendous promise. So we continue to own Alphabet. I didn't mention we do own it. We continue to like it, but we understand why there's some hesitation here. We have to let the air clear a little bit and just see what happens. But we think it's a good piece of a portfolio.
Got it. Okay, let's go to an email then. From Ben, he says, should I buy more Boeing right now? Boeing, of course, had the Dreamliner that crashed in India recently. They had problems with their MAX jets before that, couple of terrible tragedies. So the stock has dropped.
Yeah.
With what is going on with Boeing, would you expect a bounce back? Do we know enough about what happened in India yet to make that call? Yeah,
well, that's the difficulty is that reputations are easily lost, and for a very long time before the MAX 8 problems, the 737 problems, they had a spotless record, and it was almost a given that they produce safe airplanes, and their reputation has been somewhat tarnished. The 787 might prove to have nothing to do with the mechanical side of the airplane, but that doesn't take away from the fact that when the crash was reported, there was a greater intensity of analysis on that side of it because their reputation isn't as strong as it once was, and that's going to bleed through to the stock price. So I wouldn't. There are safer, better, easier places to invest your money. They are becoming more profitable as, you know, they've got a pretty big backlog. I think last I read about $650 billion of backlog, which is pretty healthy. As they fulfill that, their cash flow problems will start to go away. But they're still challenged on a financial side. And then you layer on the reputational side. I just don't think it's worth getting involved with.
Scott, we are going to take another quick break. That is all the time we have for phone calls and emails. But Gordon will share his new top picks when we come back. Welcome back. Time now to share Gordon Reid's new top picks. We start with Brinker, which I like the stock ticker is EAT, EAT, because they do own restaurants. What do you like about Brinker?
Well, what I like about it is that it's really a longer-term turnaround story. They brought in a new CEO, Kevin Huckman, about 3 years ago. He had experience in senior roles at Procter & Gamble and more recently at KFC. And he came in and he basically turned the company around. And same-store sales have been rising rapidly on the back of, you know, new menu options, a digital marketing campaign. So Chili's is their basic franchise. They own other companies as well, the restaurant chains as well. But Chili's is the main one. And 1,600 locations, 75% are company owned, which allows them to be somewhat more profitable. And same-store sales are rising very, very rapidly. So amongst the restaurant group, it just shines. And it's not inexpensive, but it also isn't overly expensive. Trades at just less than a market multiple, so about 19 times earnings. And as I say, is growing very rapidly. So we'll just let him do his magic.
Are you worried about discretionary spending from Americans, given the downturn? Retail numbers came in today and they're down?
Yeah, well, yes. But those are part of the discussions that you have when you make a decision on whether to buy or sell a company. And that was honestly a big piece of the discussion, the debate within our group in the office about, is this a good time to be moving into a consumer group? Part of it is portfolio driven, and the fact that within our small cap portfolio, of which this is part, we don't have a lot of exposure to the consumer. So the counter argument to some of us was, yeah, but we really don't have a high weighting and exposure to the consumer group. So if we want to drop one in, where should we place our assets? And that takes you right back to
Brinker.
To Brinker.
Got it. Okay, let's get to your next top pick, which is Goldman Sachs, very well known, of course. What are you liking about it right now?
Right now, it's perfectly positioned. There's been a delay in getting the tailwind of the policy benefits of the Trump administration, but it hasn't gone away. From everything I hear, capital markets groups are busy as they've ever been. We're just not getting a ton of actual deals done. So there's many, many deals that are ready to go. But after April, you know, boards are sitting on their hands a little bit. People are a little reluctant. But that will dissipate. And we're going to see a very, very strong capital markets business come out of that. They're very well positioned, trade at an historical multiple that's actually a little less than an average. Pay a good dividend, very, very well capitalized, as I mentioned earlier in the show, about the banks and the financial services companies. And of course, one of the best managed companies in the world. So great time to be involved in the financial sector, and Goldman is one of the companies we own.
Got it. Okay, let's go to your next top pick, which we did discuss earlier, Visa.
Yeah.
When somebody called in to ask about MasterCard, you like Visa, you think it has a bit of an edge.
I do, and you know, it's really a juggernaut. You know, you talk about exposure to the consumer, for example. Yes, it has exposure. If transaction levels fall, yes, you're gonna have some exposure there. But it also is the beneficiary of somewhat higher inflation, because of course they're paid on transaction volume. So if you have a little bit of inflation in the environment, that's growth money for a company like Visa. And when we look at the monthly numbers of transactions, they really haven't abated. They're getting great growth out of Europe, Latin America, Africa, good growth out of Canada. The United States is probably the one area that is a little bit subdued, but that's more because of just the vastness of it. It's a very big area. So yeah, we particularly like it, and people are moving more and more to plastic. I don't know about you, but anytime I'm put in a position where it's cash only, I think, just a minute. Well, I don't even know if I have any cash in my pocket, and if I do, I'm not sure how much.
Yeah.
So it's
plastic is a way.
It's a plastic world.
Yeah. All right, we do have to leave it there. We're wrapping up. Gordon Reid, thanks for joining us. Appreciate your time.
Thanks, Marilla.
We are going to leave it there for Market Call. Thanks very much for joining us today. We're going to take a look at the markets as we go. We'll see you tomorrow.